Welcome to Course 2, Unit 3, Lesson 3, Warren Buffett's second rule, a stock must have long-term prospects, where we'll be talking about capital gains tax. In this lesson, we have 3 lesson objectives. The first lesson objective is how to identify a company with long-term prospects. The second lesson objective is understanding what capital gains tax is. And the third lesson objective is what is the difference between short-term gains and long-term gains. So let's get started. Okay, so here we are at the second rule, a stock must have long-term prospects. So as we look at these 4 different items up on the screen, let's go item by item and let's predict whether this is still going to be something that we see in 30 years from now. So the year in 30 years from now is going to be 2042. So when you envision the future in 2042, do you see people still using iPhones? Now that might sound like maybe I'm attacking Apple, but to be quite honest, I think everyone can agree that the use of an iPhone, that there's no chance that that's going to be the type of phone that we're still using 30 years from now in the year 2042. Now, when you look over at the next item, you see candy. And that one is pretty obvious that we're probably still going to be eating candy 30 years from now. So let's go down to the next one when we look at apps. So let's say you had a company or you wanted to own a company that only made apps for smartphones, whether it be the Apple iPhone or a Droid or whatever the case might be. If you were making apps, do you think that that business model would still be viable 30 years from now? I think the programming aspect of it most definitely will be viable, but whether that specific application of it, no pun intended, would be not viable. It may be, but it's almost impossible to predict that. A lot less likely than the candy, I think we can all agree on that. And then the last one is, let's say you owned a business that made fans. There's probably a good chance that we're still going to be using fans 30 years from now. So when you look at these scenarios, these examples that I have here, it's not that we have foresight beyond recognition. We're just really looking at the application of what something is and whether we still feel that it's going to be around. And whenever you're buying a company and you're looking at their primary product, like let's say, for example, Johnson & Johnson, are we still going to have medicines? That's really their primary product. Yeah, that's still going to be around 30 years from now. So when you look at investing, Apple's an unbelievable company. I'm recording this video right now on an Apple computer. I love their product, but I would probably have a very difficult time buying their stock simply because I have no idea if that company is still going to be the #1 selling computer manufacturer in 30 years from now. So when we talk about long-term prospects, this is what we're really talking about. And this is the assessment that you have to do regardless of how much you might like a product or like a company. So predicting which companies will be around in 30 years is impossible. But ones that won't be around is a little bit easier to predict. So why do we want to invest in a long-term company? Why don't we want to invest in the Apple and hold that company for a year and then just sell it after we've made our money? And there's 2 main reasons why you want to buy a company and hold it in the long term. The first reason is kind of obvious, is because if that company has sustained earnings and it's going to keep making money, well, then it's going to continue to put money in your pocket, either through dividends or through the growth of the company and its equity. The second reason is the one that a lot of people really don't understand, and it's taxes. Okay, so I'm going to give you a really good example here to demonstrate why you really want to buy a company and hold it for as long as you possibly can. Okay, so in 2013, this is going to be our new capital gains tax bracket. If you don't know what capital gains are, if you buy a stock for $10 and you hold that stock for, let's say, 6 months, and the stock increases in value to $20, and then you would sell it, you just made $10 in profit off of the market price of that stock because you bought it for 10 and you sold it for 20 in that 6-month period. That gain you're going to be taxed on. That $10 in gain that you just made is what you're going to pay taxes on. Now the amount depends on what income bracket you're in and how long you held the asset. Since you held it for 6 months, that's considered as short-term capital gains. If you hold it longer than a year, that's considered long-term capital gains. And this is new to 2013's capital gains structure, so I'm going to cover that. Anything over 5 years is taxed at a different rate. So the longer we hold it, you can see on the chart there, the less we pay in the taxes. Now, for that scenario that I described where you made $10 on a company in a 6-month period, depending on what ordinary income tax bracket you're in, let's just assume you're in the lowest one is 15%. So you would pay 15% taxes on that gain. Now, if you would have held the business for over a year, you would have been in the 10% tax bracket. And if you held it for over 5 years, you would have been in the 8% tax bracket. So the thing you have to think about is if you would hold this company and you would have made $10 in the first 6 months and the business is continuing to make money, if you would continue to hold it for a 5-year period, you would have even made more money if it was a good business and it continued to make money, and you would have paid much less in the taxes if you would go and then sell it. So let's go ahead and demonstrate how acidic the short-term and this now middle bracket, this long-term taxes are for whenever you buy and quickly sell a stock. So let's assume that you had $50,000 and you invested that $50,000 in a 10% investment. Now I'm just using that to make the numbers a little easier, I guess. And you're going to hold that investment for 20 years. So every year, that investment's growing by 10%. And then we're going to assume that you sell it at the end of 20 years, and you're going to pay your taxes and to see how much money you would have made. So you can see after 1 year, your $50,000 would have turned into $55,000. And then after 2 years, it would have turned into $60,500. And you keep going down that chart, you're not paying any taxes on any of that. That growth, you're not paying any taxes on. And that business is just continuing to grow. And that's due to the equity, and that's also due to the dividends. Okay. Now you will pay taxes on dividends, on the income of those dividends. But as far as the actual growth of the market price, you're not going to pay any taxes on that for 20 years if you would just continue to hold it. Now, if you continue to hold that for the rest of your life and you just take the dividends, you would never pay any taxes on the market price of that company. So whenever we arrive at the 20-year mark, you can see we end up with $336,375. Okay, and let's assume that we sold it right at the 20-year mark, and we're also going to assume that we're in that highest tax bracket. Okay, so in the highest tax bracket, we would owe 18% on our taxes after we held that security for 20 years. So after the 18% in taxes, the number that we came up with goes down to $275,827. And the taxes that we would pay would be $60,547. So that's a lot you're going to pay in taxes, but you also made a whole lot of money off of that $50,000 investment. And that's primarily because of the large 10% yield. So let's look what happens if we are constantly selling and buying, but we're still making that 10% every year. Okay, so same exact scenario. We're going to invest $50,000, but in this scenario, we're going to go ahead and sell the security right before the 1 year mark, and we're going to pay that short-term capital gains tax. Okay, so the person who's out there doing the day trading, the person who buys a company and holds it for 3 months and then sells it and buys something else, this is the person we're describing here, okay? And we're going to give this person the benefit of the doubt and say that they held it for an entire year before they sold it, right before the year before they sold it. So in this scenario, that $50,000 after the first year is going to turn into $53,020 off of a 10% gain. So whenever I figured this out, there was a little bit more math than what I'm showing you here. The math after the first year would have been $55,000, but then you would have paid that 39% tax on that $5,000 gain. So what I'm showing you is after that 39.6% tax was paid. Okay, so that even though you made 10%, you only have $53,020 after the first year. And then after the second year, you can see it's $56,222, and so on and so forth as you go down. Clear down to the 20-year mark where you have $161,571 at the end. And the taxes that you would have paid over that entire 20 years was $73,149. So here's a perfect example of a person who would be investing. And this is assuming they can continue to put their investment into a 10% yielding return every time they trade it. Okay, so let's compare those two. On the left, we have the person who bought the company that was continuing to grow at 10%. So that investment turned into $275,827 after you paid your capital gains tax, and you paid $60,547. And over on the right, you have the buy, sell, buy, sell, buy, sell strategy, and you only have $161,000 in that investment, and both of them were making 10% every year. So you're talking more than $100,000 difference over the time of that single investment. The irony that I see is that when you look at the taxes that are paid, the taxes that the person paid were actually very similar, but the amount that you have in your bank account is drastically different. So this is Warren Buffett's second rule, that a stock must have long-term prospects. And the reason that he likes the stock to have a long-term prospect is because he doesn't have to pay as much in his taxes. He's avoiding paying that enormous capital gains tax by not trading it every other month or every few years. He's holding these companies with the intent to own them for the rest of his life, because he's going to continue to collect the dividends, and the market value is just going to continue to increase, and you won't have to pay the taxes on it. So that concludes our second rule: a stock must have long-term prospects. Anytime you find yourself wanting to buy a company in the short term and quickly flip it for some money, you're definitely going to want to think about this rule and how the acidity of those taxes eats away at your gains. So this concludes Course 2, Unit 3, Lesson 3, Warren Buffett's second rule, where we talked about a stock must have long-term prospects, and we talked specifically about capital gains tax. The 3 lesson objectives were how to identify a company with long-term prospects, what is capital gains tax, and what is the difference between short-term gains and long-term gains. So I hope you guys learned a lot, and I'll see you guys in the next lesson where we talk about Warren Buffett's third rule.